It's Monday evening here in Singapore. We are recording this session, which will go out tomorrow, Tuesday, 21st of June. Barring unexpected events, we expect Monday to be a low volatility day, as in the US, markets are closed and futures will only be open for half a day. Here is the weekly news calendar. This week we have the ECB and the Fed speaking and/or testifying. Since the policies were announced last week by the major central banks, we do not expect the kind of volatility we saw last week. However, please note how some events are in red while some others are in orange. The red events typically will have the potential to bring more volatility to the markets compared to the orange ones. Now, we take note of these in our trading journal so that on those specific dates we are prepared. There are also other economic news releases on home sales, CPI, inflation numbers in the US, Germany, and France, but the list is self-explanatory. Take your time, go through them, take notes. We now have an idea for when, which days, what time we can expect more volatility in the markets, and other days where volatility will probably be closer to the normal daily average. The example of the Swiss National Bank announcing a change of policy last week created a market move that was probably 3 times the normal daily volatility. So that's a great example to keep in mind what kind of volatility the central bank can bring to the market. So again, this week will probably be muted compared to the last week. Now, we speak of potential volatility. While we anticipate certain outcomes from these events, markets always have a surprise ready, and as traders, we embrace that element of uncertainty by respecting risk and being aware of these events ahead of time. And it is not a bad practice to dial down our leverage around such events to reduce risks and ensure sustainability, longevity in this business. A quick look at context. Last week in our Tuesday's video, we mentioned Japan as a big buyer of US bonds. Japan has a nice relationship with the US. They get to devalue their currency, the Japanese yen. The US gets to sell their bonds. Now, China is another large buyer. And last week, Reuters reported that both Japan and China cut their bond holdings to a 12-year low. So this is something that we need to monitor. We keep it in the back of our minds as the treasury yields will fluctuate. And well, this is probably the reason why. Even if it is not the reason, it doesn't matter. But we know that there is something happen. And during this time of enhanced political tension, this could be something that is unpleasant. So we just monitor this. Since last week, we had a slew of central banks announcing their policies and new rates. We're going to update the interest rates across the majors in this chart. The majors are US, Europe, Japan, Great Britain, Switzerland, Canada, Australia, and New Zealand. These are marked with a blue arrow for ease of reference. Note the ones that offer higher yields and the ones that offer the lowest yields. Why is that important? Well, as capital tend to flow to higher yielding currencies, longer term trends tend to form when high yielding currencies are paired with lower yielding currencies. In this list, for example, the country with the highest yield is the New Zealand dollar. And the country at the opposite end in terms of yields is Switzerland, so the Swiss franc. So this is the concept. Now let's take a look at the graph of the Kiwi Swiss to see if this is matched by the technicals. Here's the daily graph of the Kiwi Swissy. With the interest rate differential we saw earlier, we would expect to see an uptrend of sorts in this currency pair. However, this is not an uptrend at all. We have relative equal lows, which may bring some buyers into this market. However, this is not a high volume currency pair, as the trade between New Zealand and Switzerland may not be that significant when compared to, say, New Zealand, Japanese yen, New Zealand and Japan. So it maybe it's limited volumes in this pair, but this lackluster price action is definitely not aligned with the interest rate differentials of the two currencies. So we We will skip this pair for now. I'm expecting this pair to continue a little bit lower, and we may look at this once these equal lows are taken out. Let's move to the next lower yielding currency, the Japanese yen. Here is the Kiwi yen. We can see that price printed relatively equal lows in December here, then reversed and took out the equal lows in February before rallying until April, where it struggled to make new highs. It finally broke the March high, then retraced down below the 50% level of the prior bullish move A to B. Price then rallied from there. So here the price action reflects what we would expect from the pairing of a high yielding currency against a weaker one. So this is a pair we can add to our watch list and look for setups here. Let's move on and look for the next strongest pair against the two weaker ones. Dollar Swiss franc. Last week we commented in the Telegram chat on the drop that unfolded here. Price rallied strongly from April to May, printed two relative equal highs, and dropped spectacularly during last week's SMB rate announcement. It looks like this market is still settling in after that shock move, and we are open to a continuation of the move down, probably to this area here around the 95-200. It could go lower, but we want to see what market conditions are if and when prices reaches this 95-200 level. Weekly graph of the dollar yen. Price has reached old resistance that dates back to 1998, which were then last tested in January and February of 2002. On the daily graph, we can see a brief retracement last week, those two bearish candles, which could power up the pair. It's still early in the week, it's Monday night, so we will be open to evaluate long setups in the coming days here. Lastly, for this video, we look at the daily graph of the Aussie yen. Again, looking at the interest rate differentials between the Aussie and the yen, we would expect to see some rally here, some bullish tone, but looking at price, we don't see that. In fact, this looks like it wants to continue lower to the, what is that, 6750s, 6680s. So our reading, looking across the markets, is that there is something else at play preventing longer term moves, your swing trades, your position trades in these markets that we have looked at today. So we will continue to work intraday, and we will wait for markets to provide clues in the coming days. Some news: we have received positive feedback on these short videos, so we will continue doing this, and this week we will post another video looking at other markets, and we would also like to provide an update so that we can all stay really close to these markets. So all for now, stay safe and happy trading.